Indiacharts publishes Nifty daily video updates, the weekly Elliott Wave outlook, and the long short report covering all asset classes.
Hi everyone, this is the 26th of September 2020. It's the weekend and I've been thinking of putting up some of these charts all week. So finally I have some time. There's also an interesting question that came up on the comments on the website asking me about how the dollar correlates with various asset classes and how much importance we should give it. And I think that's going to be the important question because everybody has their eyes on it. But let me start first with this chart which I wanted to share. It's already been posted on the site. I'm not sure I really put it out on social media. What you're really seeing here on top is the US VIX, and at the bottom you're looking at the Dow Jones Industrials Index. Okay, so the chart I at least posted earlier was probably with the Nasdaq, but here I'm showing it with the DJIA simply because it may better link with people who are watching this index. Now what I'm going to do is I'm going to simply invert the VIX chart so that you can actually see it directly correlating with the Dow itself. So when you're actually looking at this chart now, what you're seeing is the DJI and the VIX, both of them doing the same thing. However, whenever there's a turning point in these markets, you'll actually see many times a divergence. So the type of divergence you actually see, here's a first instance. They can be smaller degree divergences and they can be slightly higher degree divergences. Is that when the market actually made a higher high in the month of February, this is around the 12th of February, where the Dow or the S&P were making their highs. The VIX actually was making a higher bottom. Now this is an inverted chart, so it actually looks like a lower top. Okay, so you see this divergence where market's going higher, but the VIX is actually not going lower. It's actually a little higher than the market itself, and that shows that volatility was already picking up in the market. And we were beginning to start seeing signs that volatility is going to pick up pace. And this non-confirmation is what following this non-confirmation, we've actually seen this very big decline in the market. Now it doesn't mean that every non-confirmation is a big decline. It simply means a trend reversal. The size of the decline is something that you have to figure out, which is your Elliott Wave view that we take, or whatever view, however you're really taking your view on the markets. Now similarly, when you reach the fag end of this decline, so as markets keep declining, you'll find that the VIX keeps also falling. So when this low is broken, on this day, which is around the 9th of March, you do see that the VIX is also confirming that further breakdown. However, at the last stage on the 23rd of March, when you made the lowest point on the Dow, you actually on this day you've made a higher high. So you made a slightly higher high on the VIX, a very small divergence ahead of this move. But can become a very, very early indication that we possibly have a trend reversal coming up. Now, these are the kind of things that you really watch out for, when markets are moving. Sometimes they give you an advance warning, and some of the divergences can be of smaller degree, some can be of higher degree. For example, here you have a lower low in the market, but the VIX continued to fall, indicating that there was a further loss of momentum, and you got a slight tick down. Now this is not a big crash, but it's a small reversal. That small non-confirmation really helped at that stage. Okay, so what I'm really going to try and highlight here is we don't see a very big divergence into this bottom here, though there is a small case for it, because here while you're making a higher high in the market, did the VIX actually make a lower low, and it actually flattened out or is slightly negatively diverged into this point. In fact, on this day itself, the reading is much lower. It's somewhere here, so there was a divergence. The VIX was actually rolling up, starting to increase in value, showing that some volatility is coming into place. Now while that has happened and we've actually fallen here to a new low, the first sell-off really created panic. So you got the spike in the VIX when you got this first decline, but when you got the second decline, which has been happening for the last 6 days, you see a non-confirmation from the volatility index. So it's just not managing to spike up despite all these swings up and down, news that the dollar is moving higher. none of that has really affected the indicator to really start going the other way. So this is an important takeaway from what you're really seeing over here, and it tells you something about what the market is really doing out here. So in short, this failure of the VIX to confirm the Dow is the first signal that possibly you're turning up. You can actually debate on the size. Is going to be a small bounce, big bounce, double top, new high, all that apart. What it's telling you is that this decline did not involve the same level of fear, which means the market is not as fearful as it was at the start of this correction. Well, the market is going to reverse. That means the signal itself is false and is not an indication of anything really happening that is significant. So here goes. What you're really looking at now on the chart is a combination of both the dollar index on top and the Nifty at the bottom. People often want to know whether there's a relationship between these two, and this is especially become true because the explanation that many have started to give, and in fact I was out giving it all the way back in April or May, that when people could not really understand why this rally is taking off from the lows of 7,500, it's not really stopping. I wrote about the reflation trade, which is essentially backed by the case that all the money that has been created by the Fed, the $2 trillion plus now almost $7 trillion on the balance sheet, reflects in a falling dollar. So what you saw when the pandemic was going on is the dollar actually spiked. Okay, so this is where we were. Okay, the dollar actually spiked. You see this big run up, and then those interventions halted that process, and then the dollar started to decline. Now few people watch these macro factors, especially global, but to try and understand this advance, I think increasingly people have come to accept that this is what is really going on. And to my surprise, this time around, when you're actually seeing this bounce back and recent correction, people have been calling me up upfront and telling me, was the dollar's going up, it's probably bottomed out, and that's going to cause the market to sell off. So that really tells you how many people have understood this narrative and have started to follow it. And partly that may be responsible for the knee-jerk reaction that we recently saw in the market, because everyone's following this indicator, and then slowly what happens is, if traders are over positioned in something, then the slightest bump up scares them, and then they dump all of it. Does that mean that's the logical thing to do? How do you really predict what is going to happen next? So you're really reacting to the day-to-day moves when you're actually looking at something like this. But what's more important to me is the big picture, because you really want to know what happens next. It's not about just what's happening now, today versus yesterday, but what's going to happen over a 3 to 4 to 6 month time horizon. And that's where my sense here was that the dollar is starting a bear market, and this has been the first 4 or 5 months of a decline. So any bounce back that you are seeing is probably a retracement of that decline, and well, sure, the retracement is causing a sell off in some assets, not all of them immediately. There's been some rotation. You've seen oil fall first, but you haven't really seen everything else fell later on. So oil did not really fall in this recent decline, but you did see gold and silver take some sharp cuts in this last part of the dollar bounce. And you also seen equities do that. Specifically, we are seeing that in the last 1 week in Nifty, that it really sold off pretty sharply. So the big change that has happened is people have started to talk about this, and that's why it's important to explain the big picture and the small picture on this. It's easy to get carried away by what is happening because sometimes these correlations in the short term, especially for short term traders, don't really work. So you can see that when the crash actually started in the month of February. So you can actually look at this. You have the point where the dollar is actually falling. Okay, so I'm using a horizontal line just to mark the entire period where the dollar has actually dropped. Okay, and it's dropped from here to here. The market actually peaked a little before the dollar was dropping, and so for a short period of time you had a falling dollar and falling equity prices. And this sometimes happens because of money actually leaving US shores. That's what I thought when US equity prices started to sell off for the first time in since October. My first thought was that, well, the dollar's falling means foreign money is actually exiting the US equity market, and that's why the dollar is really falling. But eventually it became a global sell-off, and when every other market started to sell off, the safe haven bid for the dollar actually came in. So you get these kind of deviations. It's not always perfectly correlated. What is really true is when you look at the big picture, and so the importance of the dollar, I think, first came in, and probably it's always been there, but came to the limelight in the Indian markets and for various emerging markets is after 2001, because 2002 is where you actually saw the last top for the dollar, a significant top, which is way back here. I've been moving, scrolling back and forth, but this ending pattern really ended a bull run for the dollar, and then it rolled over to the downside and started a significant decline. So if we actually just mark this point, and this is a couple of months after 9/11, so this is around 2002, start of 2002, you started a dollar bear market. So you're seeing consistently a decline in the dollar. But note, this is the Nifty at the bottom. As this dollar was falling, the Nifty was also falling simultaneously. And this has to do more with just seasonal factors. To some extent, even the US markets were still in a bear grip, because while we bottomed right after 9/11 down here, the US continued to sell off for the next 1 year, somewhere in this space, into the later part of 2002, because they entered Iraq, and there was a war going on. Probably that kept sentiment negative till this point, and then after that all world equity markets picked up. So this phase where the dollar was still falling, you still had a weak equity market. But the big thing about the dollar decline is that when you now look at it on a macro picture, when you look at the big picture, what you really have is a dollar bear market that went on from 2002 all the way to 2007, and equity bull market, if you take the same point, if this is the low point somewhere approximately, all the way to 2008. What really happens is at the fag end of any major turn in the market, there are always inter-market divergences, non-confirmations between two asset classes that tell you that something is about to change. And that is why these divergences that occur over here, just like I showed you even the recent March episode, can sometimes give you a misleading signal, and you actually have to see that signal as a sign that we are coming to the end of something, and it may be about to change in that phase, and keep a closer eye on what might be likely to change, so that you can actually spot it and tell that difference. For example, even if you go into 2008, the Nifty peaks here, but and US equities actually peaked at the beginning of this ending pattern. We peaked over here, but the dollar remained pretty much at the lower end of its range all the way into June, and so that's somewhere here, June and July. And for those of you who don't remember, that's when crude oil prices actually made their all-time highs of almost $140. They almost came close to 140, and that last rally, which was the commodity rally driven mostly by crude, occurred here because the dollar was still down. It's only after that dollar actually moved up, and then it was not just equity prices but commodity prices also that started to significantly sell off from there. So the largest decline in commodities came essentially after this point, somewhere here after you crossed June and July of that year. And then in this part you got not just equities falling but commodities falling as well, because the rising dollar usually causes a deflationary impact on the rest of the world. But that marked the start of the dollar bear market, bull market. Okay, and dollar bull markets last for typically around 9 years. So starting from around 2008, 9 years goes to 2017, which is exactly where we peaked back here. Now, while you've had this big dollar bull market from year to year, does it mean that equity prices kept falling? It's not necessarily always the case. What does happen though during dollar bull markets is it does put emerging markets, especially those which are net borrowers of dollars, at some level of risk. So if you go back to the 1990s, that's the period where you had everything from, so this is the previous dollar bull market, right? What happened to Indian equities? They were sort of flattish to down. They were under pressure. You did have this, which is the tech bull run. And during this flattish sideways period, you had several crises, including the Southeast Asian crisis, the Russian, meltdown. You had the LTCM, long-term capital management meltdown. All of that happened during a period when the dollar was extremely strong. Okay, so you do tend to get many of these crises, especially because the strong dollar puts pressure on certain economies that are not able to borrow and continue business as usual. So if you don't have a strong economy and in a strong dollar environment, you definitely need help. If you manage to get that help and stem potential outflows from your market, then you won't face the same problems, but it can slow down the pace of your advance. So in India, probably markets were just flat. We didn't see a crisis, but the economy went through a downturn for many other reasons, because we peaked in 94. But because the tech sector did well, we had this late rally into the last part of that phase, even as the dollar was rising. But eventually the rising dollar popped most of the bubbles from the tech bubble to everything else, and then you had this downturn. Okay, but when you had this downturn, the dollar started to fall. So actually emerging markets didn't do so badly during the tech meltdown. India did, because it was in its own bubble. But if you actually look at many of these markets, they didn't go below where they were in 1998, whereas the US in terms of the Nasdaq actually went below where it was in 1998. So big difference starts to happen in terms of relative performance between emerging markets and the US when you have a change in the dollar environment from bullish to bearish. But once again, when you had this bullish environment from 2008 to 2017, you've had many emerging market crises. Initially it was the bond markets in Brazil and Russia that were being hit. Once they overcame that in 16 and the dollar actually started to fall, you had the Venezuelan hyperinflation, and then you had Turkey's bond market getting into trouble. So many of these things happened during dollar bull markets, and sometimes we end up anticipating that it will create trouble even for places like India. For example, I saw this big run in the dollar coming, and I thought probably India would take a significant hit. Initially we actually went up for a while. So during the largest part of this dollar rally, the Nifty was actually going higher. So this would have looked like a direct correlation rather than an inverse correlation. Eventually we did peak and start selling off, but when we were selling off, the dollar was sort of flattish through this space, and only peaked in 2017. But once it peaked and you had a decline, you clearly see strong emerging market performance everywhere, from not just India but Brazil, Russia, China. All of them had a good phase. Many of the Asian markets also did really well in 2017 to early 2018. Finally markets only started to peak out later from 2018 onwards. I think you saw many sell-offs. US saw its sharpest sell-off right here when the dollar bottomed and started to rise again. So this is exactly where the bear market in mid-cap started. All India's mid-cap index topped here and has been in a 2-year bear market throughout this, even though the Nifty managed to scale higher highs. Same with the auto sector, pharma sector, all of them peaked here when you got this dollar advance. So the dollar advance, what I'm trying to say, does create risks. It doesn't always mean direct correlation, because as you can see, Nifty has actually made higher highs during this period. But it creates trouble for certain sectors, sometimes certain economies, and that is why we get scared of a rising dollar environment. What we are in now though is a falling dollar environment that's partly been strongly responsible for this bounce back, not just in India but in emerging markets. And if you actually do an S&P to Nifty ratio, you'll actually see outperformance of the Nifty over S&P in this time period, unlike what a lot of people might say, because it looks like the S&P is done terrifically well, but we've actually on a ratio chart started to rise, which means we are rising faster. So even though we may not be at an all-time high, we are making percentage gains. So that's right. That's what should happen during a dollar bear phase. The real big question is whether this bounce back was just a bounce back in a larger dollar bear market. Typical dollar bear markets last for around 7 years, which I can show you in this next chart. You've probably seen this chart in a couple of my other videos, and I'm highlighting it again. I'll just remove this yellow line so that what you can see is been a break of this yellow pink line. This pink line is the trend line for the entire rise that the dollar had since its bottom in 2008, but from the low point, because the trend line fits the low point from here, which is 2011, the bottom in 2014, and then the bottom in 2018. And if you touch all of those, this line is actually broken. What I'm trying to show you is somehow, for some reason, even though I say time is not an exact science, but when I just looked at the size of the bull bear markets of the dollar index from top to bottom, you see a repeated 7 to 9 year cycle. So 7 years up, 7 years down, then 9 years up, 7 years down, again 9 years up. So I said, well, if it's going to follow a 7-9 pattern, then why not another 7 years down? And if the top in the dollar index, spot index, actually was the highest level reached in 2017, and we take 7 years, then we're probably looking at 2024. So that's the big picture scenario. What you are looking at then when you really zoom into the dollar index is this bounce back is just trying to come back and kiss this pink line, trying to get back above it. But a failure would result in a continuation of the dollar bear market. Now it's been a sharp fall, so definitely a retracement cannot be ruled out. We saw a very big retracement in 2018 and 19. I'm not sure you'll get something that significant now. I think you're structurally in a larger bear market. A lot of people are still waiting to take that call. Some are saying it's just cyclical. There are only few people who've made the structural jump onto the bear side of the dollar. But I think that's the case. I think you've done the first wave, you've done the second wave, and you're somewhere in the third wave, which is continuing to subdivide. Okay, and these rallies are normal because somewhere data is also showing that there was an excessive short position on the dollar or the long position on the euro, which is partly responsible for this sharp bounce that we are actually seeing out here. So whenever you're going to get those kind of positional situations, yes, you will get short covering rallies, bounce backs, and so on. But that never really changes the bigger trend of what is really going on. So all we need to do is deal with this bounce back, and sort of we've done that in most markets. But what I would really advise is that while people have started to track this on a day-to-day basis, the reason I showed several intermarket divergences is that beyond a point, if a certain market has reached its support level, say gold or Nifty has reached a certain support, do not continue to think that every day's move in the dollar is going to directly lead to a correlation in many of these assets. You'll probably get it wrong. Just because it worked for 4 days doesn't mean it will work for 10 days. Short-term correlations are not always perfect with these assets, but medium to longer term, it does give you the big picture scenario of what you really need to expect. So once you have concluded that you're really looking at a dollar bear market, then you know that you're looking at something similar as what you saw in the last dollar bear market is a bullish period for emerging markets, or even in case of Nifty as we saw. But the only thing you have to determine how much that is going to be, and what's the size going to be and how long is it going to last. So I've already discussed time. In terms of size, I'm really leaving it open. Right now we've seen the dollar even bump up yesterday in trade, but the retracement so far is just a little over 23%. So when I put a retracement tool, you're just around 23%. Will you do 38 or not, or is this really sufficient? Because when you really zoom in on the DXY, you can actually fit it into a very small little channel from this bottom, and you've already reached the top end of this little channel. So should you really be going significantly beyond this is really a question. So I think it's too early to say. And the divergence we are seeing yesterday could also be a, this 1 day divergence also could be a signal that probably the DXY will turn, after the other assets have already done so. So sometimes that can also happen. You can get a short-term divergence between the two. So that's that. I think people are watching it so closely. They're getting used to the idea that there are day-to-day correlations between what one asset is doing versus the other. But that's not always the case. So even if we really zoom in and look at the very short-term move, here, when the dollar just made this small little move, it may look like you got this, correction in the market exactly then. But if I really zoom in, there'll be some lead lags. For example, this top occurs here, the dollar falls for 3 more days. Does that mean market still went up? No, they slided a little bit, and then they touched down here, and then when this is still bouncing back, this ended up making a higher high. So you can't really get too close into watching this on a day-to-day basis. I think what I really like to do is try to take a bigger view. So when all this was happening here, my view was clear that the third wave was not complete, and the Nifty had to continue higher to over 11,000. That was the view I was reiterating based on the larger picture development that the dollar index was in a larger 1, 2, 3, 4, 5 decline, which was incomplete. Now after such a big decline, we can argue I've been marking this as a fourth bounce. But if it holds up for a bit longer into the month end, I would probably think that this fourth wave bounce that I've been considering is actually a second wave of sorts, and you start a third down. But then should a second wave really be a big bounce? That's again a big question, because when you look at previous dollar bear markets, there are many rallies in between, but they're short-lived. You don't get those really big retracements just because it's wave 2. The currency market is very, very unusual. Look at this. This is a big dollar bear market. A lot of rallies here in between, but they always fizzle out and the downward trend really continues. So that's the thing with currencies. Bear markets can be very sharp and one-sided. Sometimes even the bull market can be that way, like this move up. So you don't really get big retracements and halts. Here you got a significant correction, but that's all it was. It didn't like go to 61% to 80%. I think the only time we saw that is here after 2008. You did see a significant retracement of the dollar on the way up repeatedly, but once again I'm highlighting that it's not always the case, and especially during the bear phase here and here you see very small bounces and then resumption of the downward trend. And each of those phases have been associated with cuts in interest rates. For example, after 2002, the Fed was stimulating by reducing interest rates throughout the period, and that's what caused the dollar bear market to really extend. Even after they started raising rates, the dollar was still falling because the trend had become strong, and then it only reversed when it actually reversed on its own. The same thing may happen now. So we started a process. I think they've intervened significantly. Expectations are for them to keep intervening, and they probably will till the trend becomes strong enough, and then after they even back off, probably that trend may continue for a while, and there'll be divergences just like the ones we've already looked at the fag end of the trend. And if you're alert enough to that, you'll probably spot it a couple of years down the line when a long-term reversal is really happening. But I don't think you're at the end of a dollar bear market. I think what you're seeing is essentially a counter trend move, and that's the relationship. I think the relationship really is long-term. The other asset class that the dollar has very close ties with is probably gold. In fact, on the gold chart, the inverse relation might actually be far more, prominent. And when you actually look at major tops or bottoms in these asset classes, you find them very, very close to each other. There may be very few lead lag effects at times, but broadly speaking, when you are in a bear market, a bull market, for example, you have this run up, you have a big decline in gold prices, and similarly when you have this big decline in gold in the dollar, then you actually have a rally in gold prices. Now, whether the rally is a bull market or whether it's just a rally as a counter trend, irrespective, for almost 3-4 years gold remained in an upward trend. So that's what tends to happen. A very high correlation, more than equities. The correlation of gold with dollar has been seen in the past. They can be short, there can be some periods where you may see small breaks in that trend, but broadly speaking, it's always true. So if you're seeing this go down, this goes up, and so if you're actually checking on the dollar and you're trading gold, you might do better than actually in equity prices, because equities sometimes move for many other reasons than just the movement in the dollar. It's earnings, then there are economic events, there are geopolitical events, and so on and so forth. There are elections. So there are many other factors that come into play. The liquidity part definitely helps where the dollar plays a role, but at a very macro level. But when it comes to gold, it's pretty much a reflection of what is happening to the currency, and that is why it probably is far more closely correlated. So when you actually do a big picture view, what you'll actually see is this is an entire dollar bear market, and prices held up till here, they were flattish, and then here when the dollar is going up, you've actually seen it decline. And then when you had this big dollar bear market all the way from 2002 to 2008, gold prices went up significantly. That was the last gold bull market that we all remember. And subsequent to that, we had the dollar move up into 2015 here, and then into 17. And somewhere in that range, gold prices have actually bottomed. And by the time you were at a 17, you were making a slightly higher high. So this was the topping out phase for the dollar, and this is the bottoming out phase for gold. Now, of course, you can see outperformance of gold to the dollar out here, but that's just part of the process of of a retracement bounce, because like I'm saying, this is the actual top. This is just a retracement, but it's almost 100% retracement, a very rare 100% retracement that we've seen, but we've actually seen it. And so gold has really not cared about that. In a sense, gold may have signaled that the dollar bear is actually coming, and that's what ended up following up. So that's how these two have behaved. But now that you see a decline, you definitely see the next big advance comes in the decline. So where you had the sharpest correction in gold here is directly correlated with this big spike in the dollar. So I think the reason gold started doing well early is that a lot of people, including me, were anticipating that the dollar would top out in this range itself. It would not do that spike that we saw because of the pandemic. And the reason is that it had already reached a 61 to 66% retracement of this. So the dollar buying, gold buying actually started because of this retracement done. It looked like that was good enough. And throughout this period, I was calling for higher highs in gold based on that. I did not anticipate this last spike. In fact, initially, like I showed you, the dollar actually started to fall, and that started to look like it was good for gold. It's only this short period of time where the spike occurred because the pandemic spread panic to all equity markets around the world that gold prices fell and the dollar spiked higher. So that was the only aberration in the overall thing. Otherwise, apart from that, the dollar had been sort of flattening out and now it's sort of declining. Similarly, we can also, because gold is a lead indicator of the commodity space, you can put the dollar on top of commodities. You'll find a very similar correlation. And this chart shows you the CRB index, which is the Thomson and Reuters CRB index of commodities, along with the dollar index. And in the big picture of things, what you see is what I'm showing you, that every meaningful move in the dollar is directly associated with meaningful moves in the commodities index. So when you had this big bull run in the commodities in the dollar index, you had this big decline in commodities. Okay, so somewhere into here, and as it happens at the fag end, you can see this bottomed out and started to attempt going higher because the dollar was close to peaking out. So sometimes at fag ends you can see these divergences which can confuse, but they're essentially indications of what's coming next. And then again you had this spike, this final spike. This has led to commodity prices falling even further. So you do see these correlations. Now it doesn't mean that the highest price in the index, which was in 2017, should be exactly the lowest price in 2017. In gold we did see that, but in other commodities we continued to see lower lows or a retest of the lows into this year. And mainly because of oil, you saw it then in copper, which made a double bottom. You saw it in a couple of other commodities as well, which simply went back to the lows or broke the previous low a little bit. Oil broke it the most. And if you actually draw a trend line of all these lows, you probably spiked below it as a final, case before really bouncing back. So as long as now you're in a dollar decline, you would actually anticipate higher commodity prices, which is what has happened so far. And if that trend continues, then this trend too would continue accordingly. The last question that I do get asked again and again is what would really change my dollar view? I mean, my dollar view, if it is that you topped at 104, almost 103.8 actually on the dollar index in 2017, you would require me to actually go beyond that for this view to change. Of course, as you go along and you make a lower high from where you can get a third wave, then I can actually change my reversal level to a lower level. Right now I'm not really able to do that because we are in the first wave down from what was a double top near 104. So in the first wave you don't know how much it's going to retrace, though I'm saying it can be small. We have seen 2018-19 do a significant retracement. So for that reason, you can't really change your view simply because retracement is going on, and so you can't put a tight level. I just can't say if it goes above 95, my view is wrong. No, it can go a lot higher and still not change the overall view. That doesn't mean I expect a lot higher, and at the same time, it doesn't really mean that it's going we've really completed something at this bottom. So neither is really confirmed, and so the big picture remains. People try to ask that question hoping that you'll reverse somewhere easy, but this is not an easy call. When you're really taking a long-term view, you have to keep the long-term level in mind. Now if you've gone say from here to here, you can actually think that this is the next level, you can think this is the next level, but eventually note even this ended in 5 waves and then this level didn't really matter. What really mattered was a retracement, and that's the situation I face here. You have this swing high, you have this swing high. These don't really matter if you're doing a larger wave to retracement of this fall. So what's going to matter is where the wave 2 ends, and once you have that and then you start a third wave, then that lower high becomes the next important point at which your dollar view changes. Another way you can really look at this is look at momentum indicators, and I could actually draw my daily, weekly or monthly momentum. Now this month you're going to actually this is of course the CRB index. I'm just going to go to the DXY standalone, and here when we actually see this green indicator on top is the momentum really, and it's been in sell mode since here. So in fact it went into sell here in late around November 2019, and then the spike in March actually caused it to almost cross back to the buy side. It didn't, so it actually creates a negative divergence. If you look at it, this is a negative divergence that we created, but definitely created a lot of fear, and then from there it continued to sell off. This is on the monthly chart. Okay, if I go to the quarterly level, We have been in sell mode since 2017. Despite all this bouncing back, we've just gone to the quarterly upper Bollinger Band. The sell signal still remains. We haven't really seen the indicator really cross back to the buy side. And right now where we are is, and as we are ending September, we are still above the 40 quarter average. So this green average we haven't closed below, which can be a support, but at the same time we have this sell signal still holding good. So at the quarterly degree, you would want this to break, to further confirm that more downside is there. So people want to see, say, 90.5 is the lower Bollinger Band and the 40 quarter average is 92. And once you're trading below those levels, closing below those levels on a quarter basis, then you're further confirming that this what I'm talking about is playing out, which is the dollar bear market. The monthly indicators, of course, remain on the sell side. The weekly indicators are crossing back, but we are coming very, very close to the 20-week average. And the 20-week average next week could be around, I think, 90, closer to 95 half maybe, or 95.30. You'll have to see the actual level as the week opens, but somewhere there. And we are already at yesterday 94.68. So you have some more space if you want to really touch the 20-week average. It's not really required because, like I showed you the flag, we've done the ABC, wave C is touched the upper end of the channel. So really don't need an exact touch point with the 20-week, but we are getting close to that point, which would be decisive for whether it gets a further continuation for a larger retracement, or it just reacts to the 20-week average and continues lower like it has done in previous bear markets, as you're really seeing on this chart. Here simply continues lower from the 20-week or the 40-week average. Here on the 20 simply continued to sell off during a trending phase, and sometimes it can even pull back, like here it did to the green 40. So how much will it pull back? But each of these retracements, like I'm trying to show you, were small. They just came to this level and then the trend down simply continued. And so that's what we'll watch out for, whether that happens this time around as well or not in the next couple of weeks. Lastly, what I'll leave you to think about, and this is the chart of the Nifty. The monthly momentum on the Nifty actually crossed back to the buy side. So the last time it gave a sell signal was here after many negative divergences, okay, and that sell signal was at the end of Feb, which means start of March, which is where it indicated that you were going to get this sell off, which followed. You also broke the 20-month average out here while that was happening. We ended up doing the exact opposite at the start of September, okay, so that's partly the reason why I'm not been really thinking that this sell off is going to be a massive decline, apart from what I've shown you earlier, that the VIX in the US not indicating that this is the start of something similar to March. So the 20-month average was crossed, the monthly momentum crossed back to the buy side. What ended up happening though a week back is the weekly momentum crossed to the sell side. So you ended up getting this divergence between the monthly and the weekly, which is partly responsible for the slightly deeper correction. But at the same time, we are close to supports here. The 20-week average this week was 10,690. Next week it will probably be a little higher, maybe above 10,700. And as long as we are really not breaking that, it looks like we look for the potential that you develop negative divergences on the momentum as it continues to stretch higher, because many times again here, just like we saw in the dollar, if averages do not break, then momentum indicators can whipsaw buy to sell many times, but trends can actually extend. And so we have to really watch this level closely before calling a bigger turn in the market. And that's where we are as of this moment, even though the weekly momentum has crossed over. So that's all in this update for you today, and I'll see you next time. Thank you.